The biggest mistake crypto investors are making right now is assuming this cycle will end the same way as the last ones. Most people are still glued to the calendar, counting down the months, waiting for a so-called cycle top, just because that's how it played out in the last 4-year patterns. But here's the reality. This isn't 2017. It isn't 2021. This market is evolving in real time, and the blueprint everyone keeps holding on to is already outdated. If you keep trading this cycle as if it's just a copy and paste of the past, you're setting yourself up to miss what could be the most important and profitable phase of this run. So in this breakdown, we're going to unpack the data, the on-chain signals, and the macro backdrop that all point towards something very different, an extended bull run, unfolding in a structure unlike anything Bitcoin has ever experienced before. We'll cover how institutional adoption and ETF inflows are literally rewriting Bitcoin's behavior, why volatility is steadily compressing, and what that means for capital flows into ETH and altcoins. And finally, a powerful compounding strategy designed for the mini-cycles dominating this market. And listen, if you're here because you want grounded data-backed insights instead of recycled hype and hopium, then make sure to hit that like button right now. It really helps push this video to more people, and it keeps us motivated to bring you the deepest analysis possible. And of course, don't forget to subscribe so you don't miss the next update. All right, let's dive in. Let's start with the elephant in the room. Bitcoin's historical cycle is officially broken. In every past halving cycle, the rhythm was predictable. First, a halving event. Then, months of supply tightening. Only after that did Bitcoin push into new all-time highs. It was like clockwork. But this time, something radical happened. For the first time ever, Bitcoin hit a fresh all-time high before the halving. In March 2024, months ahead of schedule, Bitcoin ripped into new territory. Why? Because of one single event that changed everything: the approval of U.S. spot Bitcoin ETFs in January 2024. That decision opened the floodgates for institutional capital. Pension funds, hedge funds, and asset managers could now buy Bitcoin directly through regulated products, and that unleashed a tidal wave of demand big enough to front-run what normally would have been post-halving price discovery. This was the first hard confirmation that institutional flows are no longer just a side story. They're now bending the traditional 4-year cycle. But that was only the first sign. The second one is just as important, and it's hiding in the volatility charts. If you traded the 2021 cycle, you'll remember the trauma: massive red candles, sudden 15% wipeouts, dozens of gut-wrenching drawdowns between the halving and the cycle top in November 2021. That was the norm. It was brutal, but it was expected. Now fast forward. It's 2025. We're deep into this current run, and something very unusual has happened. Bitcoin hasn't had a single 15% daily drop all year. Not one. The only exception was in August 2024 during the yen carry trade unwind. But that wasn't even a crypto-specific issue. That was a global macro shock that slammed every risk asset, from tech stocks to commodities. Outside of that one anomaly, Bitcoin's volatility this cycle has been dramatically muted. And that's not an accident. ETF inflows, institutional accumulation, and long-term holder conviction are all working together as a giant stabilizer. Every time the market dips, you see this invisible wall of demand step in. That creates a natural price floor that just didn't exist in previous cycles. Sure, corrections can still happen. 15% to 20% pullbacks are always possible if a major macro event hits. But the big difference is this: those drawdowns are shorter, sharper, and absorbed much faster than ever before. And that leads us to the bigger picture. Because what's happening inside crypto is only half the story. The macro environment is now playing a role like never before. In earlier cycles, Bitcoin often had to fight against rising interest rates, shrinking liquidity, and regulators breathing down its neck. The macro picture was a headwind. But today, the picture is completely different. Interest rates are far more likely to trend lower than higher over the next year. Liquidity conditions are loosening, not tightening. Regulation, while still a risk, is far more supportive with ETFs already live and new frameworks being discussed. This matters because it stretches the runway. A supportive macro backdrop extends the timeline for this bull run and makes it very unlikely that we're just weeks away from a final top. Instead, the data points towards something else entirely, a structural break from the old four-year rhythm. Liquidity, regulation, and institutional adoption are now in the driver's seat. And together, they've transformed Bitcoin into what it was always meant to be, a true macro asset. So if the four-year cycle is broken, what's replacing it? The answer is mini-cycles. Instead of one clean parabolic run followed by years of pain, the market is evolving into something more dynamic, a series of shorter, narrative-driven waves. We already saw this play out in real time. The AI narrative drove a pump in early 2024. The US election sparked another rally in Q4. And make no mistake, these weren't random spikes. They were liquidity rotations. This is the new normal, mini cycles within a longer uptrend. And here's the challenge for investors. Simply buying and holding through the entire run might not deliver the same outsized returns as it did in the past. Bitcoin is trending higher, yes, but the real alpha comes from recognizing these rotations and positioning into them at the right time. Most investors are still playing by the old rulebook. They're waiting for October or November because that's when the last cycles topped. But the data says otherwise, and if you keep waiting for history to repeat perfectly, you could miss the waves that are actually driving this cycle forward. Now let's back this up with the numbers. If history were repeating, Bitcoin's top would land about 17 to 18 months after the halving. That points to October or November 2025, just weeks away. But when you look at the altcoin market, the picture doesn't line up. In 2017, altcoins outside the top 10 delivered a mind-blowing 30x return from halving to just before the top. In 2021, they still managed a 12x. This cycle? Since the 2024 halving, that same sector is actually down 15%. Not up. Down. And Bitcoin dominance confirms it. In 2017, dominance had collapsed near 50% by this stage of the cycle, fueling alt rallies. In 2021, it was hovering around 42%. But today, Bitcoin dominance is still stubbornly high, about 58%. That's the strongest it's ever been at this point in a cycle. What does that mean? Liquidity is staying with Bitcoin and majors like ETH, not rotating into the wild west of altcoins. And that's another clear sign of institutional fingerprints all over this market. So the big question, how do you actually play this new environment? The answer is a two-engine portfolio. Engine 1 is your core. Around 40% to 50% of your capital goes into Bitcoin, ETH, Solana, and maybe a small basket of large-cap projects with strong fundamentals. These are your long-term compounders. You don't overtrade them. You scale in during corrections, and you scale out slowly during parabolic extensions. Think of this as your anchor. Engine 2 is your rotation capital. The other 50% to 60% is what you deploy into mini-cycles. The rules here are strict. No single trade is more than 10% to 15% of the portfolio. Wait for RSI exhaustion and a strong narrative catalyst before entering. When a position doubles, take half off immediately and let the rest run with a trailing stop. The key is what happens next. You channel profits from successful rotations back into your core holdings or keep them aside as dry powder. That way your base grows steadily, while your rotation engine multiplies during liquidity waves. Over time, this creates a snowball effect. To manage exits, I rely on two on-chain signals. First, ETH versus global liquidity. When ETH stretches into the red zone, it's historically been a strong sell signal. When it tags the green zone, it's a screaming buy. This has nailed multiple tops and bottoms with near-perfect accuracy. Second, open interest dominance. When altcoin open interest gets close to, or even overtakes, Bitcoin's, that's froth. Historically, selling into that strength has saved investors from major drawdowns. Use these two signals together, and you don't have to guess tops or bottoms. You can act based on data. Here's the bottom line. The Bitcoin of 2025 is not the Bitcoin of 2017 or 2021. It's more stable, less explosive, and far more mature. That doesn't mean opportunities are gone. It means the opportunities are different. Instead of waiting for one massive peak, this market rewards patience, discipline, and smart rotations. The old four-year playbook is dead. Adaptation is the new edge. So what do you think? Is this the dawn of extended cycles? Or will Bitcoin still surprise us with one last euphoric blow-off top? Drop your take in the comments below. I'd love to hear where you stand. And if this breakdown gave you clarity, smash that like button right now. It helps more than you know. Don't forget to subscribe for more data-driven insights. Thanks for watching. And remember, in this cycle, the real alpha is in rotation.